Hey everybody, back with another ETF review, and today we're going to be looking at DES, or the WisdomTree US Small Cap Dividend Fund. Going to be looking at this one because I've had some people ask me what the difference is in terms of risk, reward, and so on for small cap dividends versus mid or large cap dividends, and I thought this would be a good place to start. So, starting off, what is the fund? It is just like most other index fund. It has an index that it tracks, which is made up of small cap dividend paying stocks, and you can learn more about the index if you would like to. As usual, we'll start with the expense ratio, which currently sits at 0.38%. Not very high, also not very low. Really the average when it comes to index funds, passively managed funds. This is really an average price. Not too high, not too low. Nothing to write home about or be scared of. Going down to the yield, we can see that the yield is about 3%. This will change because this is a dividend ETF. Depending on when the dividends of the underlying companies get paid, you'll see the dividend payment actually go up and down, but currently it sits at about 3%. Looking at those distributions, we can actually see what they have been in the short and long term. The last distribution that was paid in August was 8 cents, 5 cents before that, 11 cents before that, 4.5 cents, 2 cents, less than a penny, 1 penny. You will be getting monthly distributions with this just because of how many stocks it holds, them paying dividends at different times, and the fund wanting to pay out every month. So again, your distribution is going to be very, very varied. So just keep that in mind. As we can see, we had less than a penny up to 11 cents. So the actual yield for month to month, the 30-day yield, is going to vary wildly, but looking at the overall, it is currently paying about 3 cents annualized, 3% annualized, so keep that in mind. Next, we can take a peek at the portfolio. We can look at the top 10 holdings. There are a few things that most people would know. Most people know Rent-A-Center. If you know small caps, you probably know B&G, Encompass. The other ones, Navient, you probably know. The other ones, not so much. You might know Vector Group. The one thing that I do like about this fund is that it is not top heavy. It is not weighted at the top. The top 10 holdings only make up 12.5% of the portfolio. So if one or two of its holdings have a bad day, a bad month, a bad year, it's not going to have a big impact on the portfolio. So that's always nice to see. It is very heavily diversified in terms of weighting its individual holdings. If we go down to the sectors, we can see that financials make up about a quarter, then industrials, consumer, real estate, and materials make up a good bit, and then we get all the way down to technology, other, not making up very much. Most of this is pretty well diversified, I would say, from consumer discretionary down to energy. Very, very well diversified. One thing that I don't like is how heavily weighted it is towards financials, particularly because these are small caps. If there is some kind of issue, if there's an economic downturn, financial companies usually do the worst, and particularly small cap financials among those will do very poorly. So that's something to keep in mind. The industrials is also a little high, but I actually kind of like that because industrials, like consumer staples, are things that are always going to be around, so I'm okay with that. But just keep an eye on that weighting towards financials. That can be an issue. So just keep that in mind. Next, we can go and look at the performance. And looking at the returns, we can see that averaging over the last year, they did almost 50%, but the stock market as a whole, like the S&P, did close to 60%, and then 100% over 18 months. So that's nothing. That's not out of the ordinary for the time that we're in, I guess I would say. The 3 and the 5 year are a little disappointing. When it comes to small caps, you want the reason that you're investing in small caps is usually because they're going to do better than large caps in times of economic growth because they have more room to grow. So seeing that 3 and 5 year is a little iffy for me. However, if we go to the 10-year, we can see that it's doing about 11.5 to 12%, which is very nice. That's doing really slightly better than the S&P 500 has done historically, so not too bad. Since inception, we can see it's about 8%, so really right around the low end of what the S&P does, the wide market. So really not a ton of difference from the wide market in this small cap dividend fund, so keep that in mind. So if you're looking for dividends as opposed to just capital appreciation, this might actually be something in that realm. Next, we can do our back test. For this one, we'll have DES in our first portfolio. In our second portfolio, we'll be looking at a control, which will be the Vanguard Russell 2000 ETF, tracking the broader small cap market of the Russell 2000, and then we'll have the S&P 500 ETF for Vanguard as something for comparison. Going down, we can see in our graph here, kind of interesting really. The funds together were all doing about the same up until 2014, 2015 when the large caps started to diverge. But both this and the wider small cap market really did the same up until the crash in 2020. They were tracking, with a little bit of exception over a couple of years, tracking almost exactly the same. Since 2020, the wide Vanguard the Russell 2000 has done better by a pretty wide margin, quite a bit, in fact. So this has trailed the wide market in terms of the S&P 500 and the wide small cap market in terms of the Russell 2000. So who is this for? Is this for you? Is this something you want to invest in, something you want to look at? I would say right now this is kind of a lemon just because of the market we're in with dividends being so low. However, seeing how it compared to the Russell 2000 over roughly a 9-year stretch being almost exactly the same returns, this could be something to look at if we do get a return to a normal-ish market, if there is a downturn and then things start to go as they have done historically. If you are looking to invest in small caps, but you are looking for dividends as opposed to capital appreciation, this might be something if that thesis plays out. Over the extremely long term, when compared to the S&P 500, you seem like you're going to do a little bit less than that, but that's kind of expected, kind of unexpected. You expect small caps to do better. However, because they're small cap dividend companies, they're not going to have the growth that larger companies have, because usually small cap companies are looking to use their cash flow to grow the company as opposed to dividends. So keep that in mind. This isn't probably going to grow as well as the Russell 2000 does over an extremely long period of time, but we can see that in some periods, for example, a 9-year period, it's going to do about the same as it. So just, again, keep that in mind. So should you be buying this? If you're a dividend appreciation investor, probably not. Small caps, while they do often raise their dividends, you're probably not going to get the crazy dividend increases that you'll see from some large cap companies. You also might not see the dividend increases every year that you'll see from dividend aristocrats, just because when companies are smaller, their cash flow sometimes gets a little bit hairier. They aren't able to increase stuff every year, so just keep that in mind. I really wouldn't look at this for a dividend appreciation ETF. I would look towards something that specifically looks for small cap dividend appreciation, if there are some out there. I'm sure there are. In terms of income, again, this is going to depend on how the thesis plays out. Currently, probably not. You can get better dividend income from plenty of other funds. 3%, I mean, you could just do SCHD at that point and still get that large cap, probably growth in this market exposure. However, if that thesis does play out, that we return to some sense of market normalcy, if you're looking to invest in small caps or dividends, something like this might work for you. It's gonna take a lot of things playing out in a certain way for that to occur. So just keep that in mind. Currently, I think there's better options out there if you're looking for equity dividends. Small cap wise, I'm not sure, but there might be better. In the current market, small caps really aren't doing anything. For example, the Russell 2000 has been trading flat since the beginning of the year. So really, I would wait to see in the future what kind of market it's going to be to see if we revert to the mean or not. Then I would reevaluate this ETF and see if it's something that I would want to invest in. I hope that helps, and thanks for watching.